This is Barry Knapp with Ironsides Macroeconomics at 7:40 a.m. on Monday morning, June 24th. This is the introductory version of our weekly video and audio summary that walks through the extensive note that we write every week, somewhere between 2,500 and 3,000 words, 8 to 12 charts and tables, complete with our portfolio and sector allocation recommendations. Our note this week was titled Earnings Crunch Time. We've had, as a side note, a number of people signing up for this introductory version, a number of whom came on the recommendation of the excellent strategist Jim Paulson, who's moved into retirement but's writing a bit now, and recommended us to his subscribers. So we thank all of you for getting involved. And again, you can find out more about what's entailed in being a full paid subscriber. The note this week was titled Earnings Crunch Time. Really that was in response to what we'd written the prior week, where we'd noticed what we were calling an unhealthy broadening out from the underperformance of small caps, driven by small banks, all really attributable to the tight bank credit channel, the deeply inverted yield curve due to the suboptimal Fed tightening process we've written so much about, and underperformance of consumer discretionary. That had actually broadened out to all of the cyclical sectors. So the rally had become even more highly concentrated in tech and communication services. A client on a Zoom call asked us, well, what about the fundamentals? And so we dug in on that. And that's what this week's note was primarily about. We began with a discussion about the Countertrend US Treasury Rally. And that, of course, comes on the verge of what we've often referred to as bellyache week, when the Treasury issues 2s, 5s, and 7s, like they're going to do Tuesday, Wednesday, and Thursday of this week. That's often caused a pretty good backing up in yields. But in this case, the market, we expect to take that relatively well, because we've had a decided weakening of macroeconomic data, which coincides with underperformance of these cyclical sectors. So after going through the market comings and goings and reiterating our structural cyclical bear market call, and how it's analogous to what happened in the 50s, 60s, and 70s, where banks slowly unwound their treasury holdings from the rate caps in place during World War II. It's very analogous to the Fed's portfolio in QT currently. All the while, the budget situation kept getting worse, driving up the supply of treasuries and ultimately leading to, a 3-decade bond bear market. We think we're in a similar dynamic, but right now we're in a counter trend rally because the data is weakening. Last week, in particular, we had soft retail sales, housing starts, and jobless claims are finally starting to pick up. And so we detail that in the note, and how there's decent risk of a growth scare, but still minimum risk of a recession because of government spending, because of government transfer payments to individuals being at all-time records, with the exception of during the depths of the pandemic, and 100 basis points above where they were pre-pandemic as a percent of disposable income. So we don't think the recession risk is high, but we do think the probability of a growth scare is growing. And we made a portfolio change to our fixed income allocation, extended duration a little bit as a consequence, to cushion the more cyclical holdings we have within our equity sector allocation. So moving on to that earnings crunch time. Last quarter, we had about 8% earnings growth, but it was entirely attributable to tech and communication services. Everything else actually fell 0.5%. So we are having an earnings recovery out of our 3-quarter earnings recession, the fourth quarter of 22, first 2 quarters of 23. This is the quarter when it's expected to broaden out. Market expectations are for 10.7% growth, but even taking tech and communication services out, which are going to contribute 30%, almost 50% of the earnings growth, earnings are still expected to grow 7.7% for everything else. Having said that, the chart I have up here, if you're looking at the video version of this, shows you net revisions falling somewhat for discretionary and in the industrial sector. The share prices are not acting like they're about to get a big recovery in earnings. Typically, the rate of change of earnings growth drives share prices in multiples, and that's really not happening. So this quarter is going to be crucial. It gets going in about 3 weeks' time, and it really is crunch time for the rest of the market. So that really summarizes the gist of the note. I mentioned the portfolio change we made to try and cushion some of the risk. The idea is we could see 5-year notes rally to 4% or so if the growth scare extends. If the Fed does, or the issues around the labor market are resolved the way we expect them to, which is to be getting a preliminary benchmark revision that shows that we created something like 1 million less jobs in the year ended the first quarter of this year, the Fed could very well be tightening in September, at which point we'd probably look to go the other way in our Treasury portfolio, because we do not expect 10-year notes to rally sharply unless we have a recession, even with Fed rate cuts. We think that could actually be a selling opportunity, but more on that later. Barry Depp from Ironsides Macro. Again, thanks for signing up for the introductory version, and please, by all means, consider becoming a full paid subscriber to Ironsides Macro. Thanks, everyone. Have a good week.